So I'm in your textbook on page 721, and I'm going to be completing piece 16.5a, which asks us to prepare a cash flow statement using the indirect method. So I'm going to begin with the first section of the cash flow statement, which is called the operating activities, where we're going to calculate cash generated by, if it's a positive number, or used for, if it's a negative number, operating activities. And when we do that, we begin by converting the accrual basis net income, which is given in the question of $108,000. That's in the additional information at the bottom underneath the two balance sheets that it gives you. We're going to convert that net income accrual basis of $108,000 into the cash basis. So the first step to do that is to remove the effects of any non-cash items that have been included in this net income. Probably the easiest of those to understand is the depreciation expense. You might find it kind of odd that I'm saying add the depreciation expense when an expense is usually subtracted. But we have to remember that the expense has been subtracted from this $108,000 already. And it's a non-cash expense, meaning you don't send somebody a check for your depreciation. When you debit depreciation expense, you credit accumulated depreciation, never cash. And so for that reason, we need to add back our depreciation expense here. Unfortunately, the question doesn't give us the depreciation expense. Sometimes it gives an income statement where we could have taken this net income and found the depreciation expense. Other times it might give you the depreciation expense in the additional information the way it did for profit. In this case, we're going to have to use the balance in accumulated depreciation to calculate the depreciation expense. So I've set up some T accounts for every account on the balance sheet, divided into the three sections: operating, investing, and financing. So the accumulated depreciation, because it's related to the long-term assets, I put it in the investing section, even though our depreciation expense is going to go in the operating section. We need to think about what happens on both the debit and the credit side of accumulated depreciation, because we would credit accumulated depreciation for the amount of our depreciation expense in the year, but we would also debit accumulated depreciation if we disposed of an asset that had depreciation on it. Now, it tells us in the additional information that no equipment was sold during 2014, so there would have been no debits to the accumulated depreciation account because equipment is our only depreciable long-term asset here. Land doesn't depreciate, and that means the entire difference in the accumulated depreciation account is the result of the depreciation expense. So I'm going to go back to my cash flow statement and pick up that number. And now I'm going to move on to other non-cash items that have been included in net income. We're told that land with a cost of $50,000 was sold at a loss of $20,000. Gains or losses on disposals of equipment have already been added to or subtracted from net income, but themselves are non-cash gains or losses. So this loss has already been deducted, but it was not cash. So I'm going to add back the loss on the sale of land, and we're lucky that we're told here how much it is, so we don't have to go and calculate it. If we had a gain on sale of land, we would subtract it here, but we don't. So we're going to move on to what I would say is the second part of the operating activities section. So the first part was removing the effect of non-cash items. And now we're going to look at the changes in the current assets and the current liabilities in order to finish adjusting accrual-based net income into cash basis. So if I go to my operating activities page here, I have a T account for my three current assets, and I'm going to think about the effects of accounts receivable on the relationship between net income and net cash received. So in this case, net income increased, got bigger over the year. And in order for the, sorry, accounts receivable increased, not net income increased. So accounts receivable increased over the year by $9,000. In order for accounts receivable to increase, that must mean that sales on credit, which is when you would debit accounts receivable, are greater than cash collections, because we would credit accounts receivable in the event of cash collections. And so if this account went up, the debits must be greater than the credits, and so credit sales must be greater than cash collections. And if credit sales are bigger than cash collections, that also means that accrual-based net income must be greater than cash flow. And so the rule, in order to adjust net income to cash flow, we're going to subtract the increase. And that is a rule that will work for all assets. If you have an increase in an asset that isn't cash, it means your cash has depleted. And so I'm going to take this increase in my accounts receivable and I'm going to say less increase in accounts receivable of $9,000. And now I'm going to look at my inventory account. It also increased by $12,000, sorry. And if an asset increases, I subtract the increase. So I'll go back to my cash flow statement and say less increase in inventory. I just noticed that when I put that number in for accounts receivable, I didn't enter a negative before it. You don't actually have to because you've already said less. But when these numbers are already showing as negative numbers in brackets, I'm going to be much less likely to make a mistake when I calculate my cash from operating activities in a few rows. And so I have one more current asset here, which is a prepaid expense, such as prepaid rent or prepaid insurance. And the prepaid expenses have decreased over the year. So we have to think of what happens on the debit and credit side of prepaid expenses. We know that it has decreased by $2,500, which would not happen on the debit side, it would happen on the credit side. And for this account to decrease, it must mean that the credits were bigger than the debits. So when prepaid expenses increase, it's when you actually make payments on them. And when prepaid expenses decrease, it's when you're using them up by expensing them. So in this case, your payments must be less than your expenses because you expensed more, you used up more prepaid expenses than you purchased during the year. And if your payments are less than your expenses, then your cash flow is actually greater than your net income. And so you're going to add the decrease. And we're going to add that to our little cheat chart over here. You can add a decrease in current assets. So we've now dealt with our non-cash items and our current assets, and we now just need to deal with our current liabilities, and then we will finish with our operating section. Notice that I've only put 2 of the 3 current liabilities here, accounts payable and income tax payable. That's because the third current liability that you see, called dividends payable, is actually not an account that affects net income. Dividends are paid after net income has been calculated, and Therefore, we're going to deal with it in the financing section. So you'll see over here, I've got an account set up for dividends payable that we will deal with later. So I'm going to start with income taxes payable. I think it's the easier of the two to understand, and then we'll figure out what our rule is and how it affects this chart. So we see that income tax payable decreased, and it's a payable, so it would decrease with a debit. Now, in order for income tax payable to decrease, it must mean that we paid all of this year's tax and some of last year's. Or more accurately, or I guess more specifically, that our payments on accounts payable are greater than our expenses. Because when you pay your taxes, you would get debits, and when you expense your taxes, you would get credits in this account. So if your payments are larger than your expenses, then your cash flow would be less than your net income. And so you're going to subtract that decrease. So when you have a decrease in a liability, you subtract it. So I'll flip my sign to negative there. And finally, I have one more current liability, which is our accounts payable, which increased by $5,000. So we have to go under the assumption that payments happen over here, and whatever gets credited over here is eventually turning into an expense anyway. And so you have payments over here, expenses over here. So you've had more credits than debits. So in this case, your debits, which would be your payments, are less than your expenses, which would happen on the right side of accounts payable. And so, therefore, our cash flow would be greater than net income. And so we're going to add that increase. And we'll put that into our little cheat chart. And I'll come back here and say add increase in accounts payable. Just a note on this chart, it's there to help you, but you really want to be able to rationalize through at least one asset account and at least one liabilities account, because if you try to create this from memory, but then you mix up, maybe you put these two rows wrong or you put these in the wrong order, you won't just get one wrong, you'll get all four of them wrong if you're just trying to remember this pattern. Whereas if you can set up the chart and then rationalize through one account, like accounts receivable or taxes payable, those are the two that I find the easiest, then you can anchor your chart by knowing that you're absolutely right about at least one of the four quadrants here. So now that I have eliminated the effect of non-cash items and dealt with the changes in current assets and current liabilities, I'm going to add up the net effect of those adjustments. And I get a positive number, so this is now called cash. I'm now going to add those positive adjustments as the result of all of these changes to our net income. I'm going to call this cash generated by operating activities. And if it was negative, I would call it cash used for operating activities. So I'm going to stop the video here, and I'm going to do the investing section in the next video.